So last week, Tesla released their earnings, and oh boy, that was some really bad earnings, and the stock immediately fell by 13%. Look at how they massacred my boy. I usually don't like to talk about Tesla because of how polarizing it is, but I decided to make this video because there were some people who wanted to kepo how my Tesla was doing, while others were genuinely concerned about what they should do with their Tesla stock now. So in this video, I'll be sharing my thoughts on Tesla. Is it even worth investing now? How low can it go? And finally, I'll also share what are my plans for my Tesla holdings. Also, do join my 7,000 members Telegram chat group to discuss or ask any questions that you may have. Alright, let's go through the earnings first. I will first talk about the bad and ugly stuff, followed by the good stuff later. Overall, Tesla has missed analyst expectations. The earnings per share came in at 71 cents versus the expected 74 cents. And for revenue, while analysts were expecting $25.6 billion, actual revenue only came in at $25.17 billion. Going through the actual report, total automotive revenues have only increased by a super tiny 1% this quarter. And obviously, that's bad, right? Because automotive contributes a whopping 85% to Tesla revenue. And even though energy and services revenue did increase, it didn't help much with the situation. Next, gross margin has been consistently going down from 23.8% back in Q4 2022 to now 17.6%. This was due to Tesla constantly cutting car prices in order to boost demand. And the bad news is that the price cuts may not be over yet, so we may see the gross margin going down even more. Meanwhile, Tesla's solar business has continued to shrink as its solar deployments have been going down. Tesla said that this was due to the high interest rates. But personally, I wouldn't worry so much since solar is just a tiny part of Tesla's business. Then finally, the most worrying part is that Tesla warned that vehicle volume growth rate will be notably lower in 2024 as compared to 2023. The keyword here is notably, because you normally won't use the word unless it's a lot lower than what people are expecting. So from 2022 to 2023, the growth rate was about 38%, which by itself was already pretty bad, as it was already below their original 50% growth target. But how much lower can it go? I don't know, but analysts are now expecting Tesla to just sell 2.2 million vehicles in 2024. So there's only a 21% growth rate. As to whether it will come true or not, we'll just have to wait and see, yeah? So those were the bad stuff that came out of the latest earnings, and there's no denying it. The numbers look pretty bad. So much so that when the result came out, short sellers were busy shorting the stock and made more than $2 billion that day. But now, let's talk about the good stuff, because believe it or not, there were actually some pretty good things that came out of the earnings. First, Tesla is still financially strong. Despite everything, free cash flow still came in at $2 billion, and they are currently sitting at almost $30 billion cash. They are practically debt-free and can weather through tough times ahead, like right now. Second, Tesla has managed to reduce their cost of goods sold once again. They do this by improving the cost on all points of production, such as raw materials to final delivery. But of course, there's a limit to how many things they can optimize. So the real growth potential must come from somewhere else. And that brings us to the energy sector, which is doing really well. So even though their solar deployments have been going down, their energy storage deployments have gone up by 125% as compared to the previous year. And even though energy is just a tiny part of the revenue now, it is potentially one of Tesla's S-curves. So back in 2020, Elon mentioned that given that the energy sector is much bigger than the automotive sector, the energy sector could potentially be as big as the automotive segment in the future. The other growth potential is FSD, of course. So after Tesla rewrote the whole FSD software last year to use neural networks for their training, it is now finally ready for testing. So they have started rolling it out to their employees to test. During earnings call, they also mentioned that this would further roll out to all customers in North America in the weeks to come. Though, so far, no other car companies has taken up Tesla's offer to license FSD. But given that it's already been proven that FSD can indeed make driving safer, and given that there's no one else that's even close to FSD, I believe that it's just a matter of time before other companies start licensing FSD from Tesla. So it's once again like Tesla's supercharging standard, where the competitors have to either adopt the technology or get left behind. Quick pause. Did you know that Momo Singapore has a wide range of useful tools to help you analyze companies? And one of them is following companies' earnings. So at the stock page, if you tap on company, then tap on Earnings Hub, you'll be able to see a quick overview of the latest earnings, such as how did the actual result compare to the analyst estimates. Momo Singapore also shows you a quick breakdown of the company's operating data, such as how many products they sold in the last quarter and what's the growth rate. But if you are interested to read the actual report, you can tap on Earnings Report to find out more. Otherwise, you'll find a quick summary of the earnings call as well as the replay of the actual call itself. Further down, you will see some analyst ratings and what they think about the company. But the one feature that I like the most is that you are able to see what other investors think about the company, as well as engage in discussions with them to learn from one another. Right now, Momo Singapore is offering some very generous sign-up promotions. You get to enjoy a 6.8% per annum guaranteed returns for up to 31 days on your first $60,000 invested with Momo Cash Plus. Besides that, they are also offering the new Fullerton SGD T+0 fund, where it's the first retail SGD cash fund that has enhanced intraday liquidity. Please note that Momo Cash Plus is an investment product. Principal is not guaranteed and up to 31 days of 6.8% per annum is guaranteed only during the promotional period. After the promotional period, interest is not guaranteed. This is not comparable and is different from a savings deposit. Investment in any capital market products involves risk and the risk of losing principal. Besides Momo Cash Plus, if you deposit a minimum of $10,000 and perform 8 buy trades, you will get to receive 4 stock bundles worth $280 in total. Or if you can deposit a minimum of $100,000, you will get 4 stock bundles plus 1 Apple share. And if you sign up using my link, you will get up to $20 cash coupon exclusive rewards. So that is $900 worth of welcome rewards in total. So if you are interested in taking your investments to the next level, do try out Momo Singapore. For more details of the promotions, do refer to the link promotion page in the description below. And with that being said, let's get back to the video. The third growth potential will come from their $25,000 next gen vehicle. So it's exactly like what was mentioned in Tesla's not so secret plan back then, where they first start with a sports car, then use the money to build an affordable car, then use the money to build an even more affordable car. Some call it Redwood, others call it Model 2. But whatever the name is, it will be their next budget car. You know how recently there was the news that BYD surpassed Tesla in sales and everyone was like,
"Bro, BYD is better than Tesla now because it sold more cars."
Not really, yeah. That was just because Tesla cars have an average selling price of $46,000, while BYD average selling price is a lot lower at $25,000. Basically, Tesla was targeting the premium market, whereas BYD was targeting the mass market. But now, with Tesla's $25K budget car, this will now finally allow Tesla to compete in the mass market segment. According to Elon, the car will come out in late 2025. But I think with Elon being Elon, it's better to give him some buffer and expect it to come in 2026 instead. Then we also have the ramping up of Cybertruck, which means more car sales, and the fact that their 4680 cells won't be a limiting factor is good as well. Last but not least, Tesla is planning to start shipping Optimus in 2025. While I don't believe it will be ready for home use yet, it could certainly be ready to help out in other Tesla factories next year. And whether you believe in Optimus or not, I think we can all agree that it is progressing very nicely. Just 2 years ago, the bot could barely stand on its own. But now, the bot could already walk, pick up delicate stuff, and sort things. And not to sound like a broken record, if this continues progressing, this will again be Tesla's next S-curve. So now comes the important question. How low can Tesla fall to? And what is its intrinsic value? In order to make this a meaningful discussion, we need to accept that Tesla is more than just a car company. Because if you think that they only sell cars, then they should only have the same PE ratios as the other car companies, such as Toyota, Ford, and GM. In that case, Tesla should only be worth around $25. Now, the most comprehensive way to value a company is to use the discounted cash flow, where you project Tesla's future cash flow and use it to calculate the present value. But the problem with that is, Tesla's free cash flow is all over the place. Sometimes it's as high as $3.3 billion, other times it's $0.4 billion, and so on. So it's hard to value Tesla this way. For example, if I use the latest 12 months free cash flow of $4 billion in my discounted cash flow calculator, I will get $26 intrinsic value. But if I use 2022's $7.5 billion free cash flow, I will get $43. By the way, the reason the numbers are so low is because I used a 17% discount rate, which was calculated using the company's financials. In my friend's Bunti video, which I highly recommend you to check it out, he pointed out that Adam Khoo was using an 8% discount rate. So if you were to do that, you will get $47.53 if you use 2023 numbers and $89 if you use 2022 numbers. But then, in another one of Adam Khoo's videos, instead of using free cash flow, he used net income since it's a lot more consistent. And with that, he got $151. Bunti also pointed out that another analyst, Professor Damodaran, projected each line of business individually to come out with an intrinsic value of $179.56. So now, you have a range of numbers from $26 all the way to $179.56. But I would say that the intrinsic value should be somewhere on the high end of this range. Can Tesla crash all the way down here? Yes. In fact, it's already at $183 as of making this video. But realistically, how low can it go? Right now, Tesla has a PE ratio of 59. So if we assume Tesla has the same PE ratio as BYD, which is 19, Tesla could crash all the way down to $62. Personally, I doubt this will happen unless things get very bad for Tesla to the point that everyone stops believing in Tesla's growth story. Like its profit margin drops to zero, there's zero growth or even negative growth, the $25,000 budget model gets delayed for another 5 years, and so on. Right now, Tesla has a support point at around $150. So my guess is, if it continues to crash, it could reach that price in the short term. Though, by the second half of 2024, we should expect some good news to come out, such as the interest rates are going down, which will further boost demand and Tesla could increase car prices again. More details about the 25K budget model, which will hype Tesla out all over again, and further ramping out of the Cybertruck and Tesla Semi. So what's my move for Tesla? For those who are curious, I'm currently down by negative 14% on Tesla, not including the profits that I've gotten by selling Tesla options. And since I wanted to diversify my portfolio, I haven't been adding on to Tesla since the middle of last year. Instead, I was busy adding on to other positions, such as the S&P 500, QQQ, and other tech stocks. So now, my Tesla allocation has already been reduced down to 50%, and I intend to reduce it even further. Though, if Tesla did drop to around $150 to $160 kind of range, I might just consider adding more. All in all, short-term wise, I'm bearish about the stock. But this was already expected to happen more than 2 years ago, so there's no surprises here. Long-term wise, I believe the growth story is very much still intact. So also no worries there. Anyway, that's all for this video. Hopefully you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.